then they'll be able to join. I just recorded it just for our group. So, you know, if you have R-rated language, that's fine. I can beep that out later. So thank you all for attending. Nate, just so you know, I think I've talked a little bit to you, but this is basically a group of people who are interested in passive investing, syndications, and we're kind of helping each other learn about syndications and invest in syndications. Some are doing a tribe vest group, so we're investing together, and others are just investing for their own account. Most everyone here has a W-2, so they're doing this kind of on the side of their regular job. And I think there's a few of us that have done a couple of syndications, and there's a larger group that have done none and are looking to. So our goal today is just to kind of have a conversation about tax with the focus on passive syndications. And I know I sent you an agenda, and I'd like to go, or not an agenda, but just kind of a list of what people were interested in. I want to start in a different place that I didn't put on there. But first, to everybody else, I just want to introduce Nate. He's been my tax accountant for, I think, three years perhaps. And he invests in real estate himself, and he does a really good job. Even before COVID, he was all virtual. I mean, you could go meet him if you want, but he takes everything online. He does a great job. He does strategy sessions with me, and he's helped me understand a little bit better how the tax thing works, especially with what I'm doing now. And so, Nate, I'll turn it over to you, and you can just kind of go through. But the first thing I'd like you to talk about after you maybe just do a little bit of introduction about yourself, because I didn't do a very good one. But you talked to me about the tax buckets: active, ordinary, portfolio, and passive. If you can start there, just so we have an idea of where everybody's at, and then go through I think we talked about depreciation on syndications, including cost seg and bonus, oil, gas, conservation easements, pluses and minuses of IRA syndications, self-directed conversions to Roth, and then 1031 exchanges. I know that's a lot, but if you start with the buckets and go on through, does that sound like a good plan?
Yeah, that's fine by me.
Awesome. Well, I'll turn it over to you. And then if you guys have questions, I think it'd be most productive if you can kind of wave or just maybe interrupt. I know it's hard on Zoom. I don't want to save all the questions to the end. Or you can send them in the chat, and we can kind of see them there. But with that, I'll turn it over to you, Nate.
Thank you, Jim. Just a little bit about myself. I'm a CPA here in New Albany, Ohio. We have clients that we work with, not just throughout all of Central Ohio, not just throughout Ohio, but in all 50 states. So we're not, I'm not bound by working with people in person. Jimmy touched on it a little bit. I've always been capable of working remotely. I'm 35 years old, so I know how to work a cell phone, know how to work the old electronic mail, and gadgets that allow us to help folks, remotely in efficiency. So I'm not really an old school guy that requires you to bring your box of receipts or set up a meeting. We're very fluent with Dropbox, Google Drive, all these different ways to transmit information remotely, electronically, fast, smart, etc. So, again, it's kind of my style, working with clients on that end. Jimmy mentioned I'm a real estate investor. That's true. I've been investing full go for about four years now. I think right now, I'm starting to sell some of my units, but right now I've got about 60 units here on the near east side of Columbus. I'm a side-by-side duplex guy. My stomping grounds are Southern Orchards, King Lincoln, Old Town East, German Village, those sorts of places. So that's kind of my experience in my wheelhouse. I like active real estate investing for now. But I could see myself starting to do a little bit more of what today's subject is syndication and portfolio type investing is what I refer to. It's much more passive. You're not having to deal with a lot of the hassles of, the active real estate investing. So again, today's topic is appropriate because again, that might be a chapter in my life I might be moving towards as I liquidate my current portfolio. So, a lot of the topics today that I'm going to advise on involve these three buckets, and I'll explain that quickly. If there's anything that I think you should take a note on, get a piece of paper out, get a pencil, take notes on, it's what I'm going to talk about for the next 60 seconds because it just totally shapes your understanding of what I'm going to talk about, not just in the syndication stuff, not just in oil, gas, wells, but it should totally shape the way that you think of investing and how it relates to your income from a tax standpoint, in your W-2 income, that is. So there's three buckets of income here that get taxed, and they get taxed differently, and they have different rules, and the losses on each bucket of income are handled differently from a tax standpoint. The first bucket should be the most familiar bucket with everybody. It's your active and ordinary income. Okay, that's bucket number one. Active and ordinary income. That's your W-2 income. That's your side business income that is an active pursuit of income. And what I mean by that is if you're a real estate agent, a broker, you're a service provider, you are wholesaling homes, you're flipping homes, you are engaging in an activity that is an active and ongoing, consistent pursuit of profit. Investing in real estate from a rental standpoint and a long-term hold does not qualify for that. That falls into a different bucket. I'll get to that in a second. But these active and aggressive short-term pursuits of income, including your W-2 wage job, these are all active. And active income, by no surprise, tends to be the most aggressively taxed. And for a lot of you, when you're investing in real estate or syndications or these sorts of things, you're trying to find ways to shelter your active income. And a lot of folks look to investments to create losses that can easily shelter active income. And prior to the Reagan tax reform in 1983, taxation was the Wild West. The highest tax brackets were 70, 80, 90% in some cases, but the rules to shelter your income were extremely lax. In other words, you could go out and buy a rental property or a bunch of rental properties, or you can invest in these syndications and get these massive first-year deductions, and there would be a total unrestricted use of those losses to offset your active income. So there's a lot of this arbitrage going on with finding all these investments that create losses to offset your income so you're not paying a 90% tax rate. That is worlds different than what we deal with now. We don't deal with these aggressive tax rates, but we don't have a lot of these really super aggressive loss or tax shelter strategies available either. And you're going to find that out as I go into these different buckets, why that is. So again, bucket one, active losses, active profits, active businesses. Again, there's not really a limitation on loss if you have an active loss producing activity. Let me give you an example. Let's say you have a W-2 income where you make about 100,000, and then you decide to be a realtor. And in the first year, you are a bad realtor, okay? Let's say you maybe get one listing sold and you're racking up a bunch of dues, you're racking up a bunch of broker fees, you're trying to pay for some advertising, it's just not going well, you don't close a single deal, and you turn a $10,000 loss. Well, a real estate agent activity is an active activity. It's an active pursuit of income. So that $10,000 loss is fully deductible against your W-2 income. An active loss can easily offset active income with no limitation whatsoever. Again, there's other rules involved with that, but from a very simplistic understanding, you can bank on that. An active loss activity or an active pursuit of income that generates a loss can offset other active activities such as W-2 income. It's bucket one, very easy to understand. We move into bucket two. I mentioned rental properties. Bucket two is where things get pretty interesting. It's passive activities, all right? Passive activities are activities in which there isn't an ongoing active pursuit of income, but it's basically an investment where you're not having to punch the clock, you're not really having to work 9 to 5, you're generating income. It may require some activity, but it's not going to require an active, consistent, ongoing pursuit type of activity. Rental real estate is definitely in this category, as is investments into syndications that also invest in real estate. These are considered passive activities. We come back to the real estate agency example I laid out. Let's say this real estate agent had a partnership, and let's say they had a money guy partner up for a 5% interest. Money guy had no involvement whatsoever in the management. He's just pumping money into his investment, and he's hoping to get a return on that 5%. And let's say in the first year, money guy is entitled to 5% of the loss. That is considered a passive loss, because money guy is not actively pursuing the profit. He just put money in, and he's expecting some sort of a return for very little work or management whatsoever. Money guy's interest in this real estate agency business is passive, whereas sweat equity guy, the realtor, who's doing 90, he owns 95% of the company, doing 100% of the work, he has an active pursuit. So his losses are fully deductible, whereas passive guy falls under what's called passive losses. Before I go any further, does anybody have any questions so far? Is this making sense? Everybody's good? Okay. Feel free to interrupt me at any point, please. So going back to passive loss rules. What do passive loss rules mean? Well, passive loss rules on the surface, I'm going to start with the biggest blanket rule. And the big blanket rule says passive losses may not offset non-passive streams of income. This active bucket that we talked about, that is a non-passive stream of income. It's an active stream of income. So passive losses on the surface cannot offset that active bucket of income, okay? And there are some exceptions to that. I'll get into the most widely understood exception to that. There is a $25,000 allowance for rental real estate losses to offset your active income, okay? So there's this rule that just says, hey, one exception to this passive loss rule is you can invest in rental real estate. And of that, your rental real estate investment, you're entitled to $25,000 of rental losses that can offset your wage income. But there's some conditions. Your wage income or active income, those things can't exceed $100,000 in a given year, okay? Once your active income exceeds $100,000, for every dollar that your active income is over 100,000, we're going to reduce that $25,000 rental passive loss allowance by 50 cents. So in other words, once you get to $150,000 of active ordinary income, you have zero passive losses allowed from rental real estate against your active bucket, okay? And a lot of you might make over 150,000, and a lot of you might file your tax returns. You might notice that when you have rental real estate, your passive losses, they're not getting used. They're getting carried forward, okay? So what happens to those passive losses? Do you just lose them? Do they get carried forward into perpetuity? When do we use them? Well, the passive loss rules state that for any unused passive losses, they get carried forward against future passive income, or if you dispose of the activity, either or, okay? So we come back to money guy who owns 5% of this real estate agency business. Let's say after 5 years, this is the worst real estate agency business in Columbus, and each year keeps showing a loss. And after 5 years, he's racked up 50 grand of loss. And let's say after 5 years, he's like, to hell with it. I want to dump this business. This is a loser. I'm going to get rid of it. If he disposes of his interest and tells 95% sweat equity guy, hey, I don't want this anymore. I'm just walking away from my interest. He can write off his $50,000 passive loss in year 5, even though he never had any passive income to offset it. So that is another exception to the passive loss rules. If you have an activity that has always been passive, you've never had passive income, if you dispose of it in year 5, you get to write off all that loss in full. So that's nice, I guess. So, again, that's one other thing to keep in mind with passive losses. One other exception I'll bring up, and I'm not going to get into this a whole lot today, but a lot of you probably are familiar with the real estate professional exception to passive losses. If you are what's called a real estate professional, which basically means you don't really have a W-2 job. You're just all real estate. You're this real estate agent. You own rental properties. You have a license. You are just real estate full time. That those passive loss rules, if they pertain to rental real estate, don't apply to you anymore. So you get an unlimited use of rental real estate loss that can offset your active income, as long as your active income is full-time real estate. Again, full-time real estate broker, full-time real estate agent, et cetera, et cetera. So if you're everything is real estate to you, you aren't subject to those rental real estate loss rules that limit you to $25,000 and your income must be below 100,000. Is everybody good on that?
Now, Nate,
Yes.
so thank you. This is very helpful. So what about, like, say a spouse? So say if your spouse like stays at home, she could be considered a real estate professional, and then she could theoretically offset some of your passive, so some of my active W-2 income. What are the requirements for that?
So there is an either or rule. All right. If you are married, that is correct. Either you or your spouse could qualify as a real estate professional. And if you or your spouse qualify as a real estate professional, all passive losses as they pertain to rental real estate amongst the married couple may be deductible against all active income. A good example, let's say one spouse is a doctor making $750,000 a year, and let's say other spouse manages a rental portfolio of 100 units that year after year after year, through cost segregations, through depreciation, through good tax planning, shows a large loss of 100,000 per year. In that example, as long as the spouse that is managing the rental real estate, if that's all they do, then as a couple, they can offset those two streams of income. That's absolutely correct. Now, there's more requirements in there. And if I got into the real estate professional exception, this particular thing, this could last the length of the call. And, you know, Jim, if you're getting a vibe for the group and you're thinking this time is better spent on that, sure, more than happy to do it. But it's good to know that it's just there. So again, that is true, Mark. Either you or your spouse needs to qualify. It doesn't need to be both of you. And as a couple, you could use one spouse's rental real estate losses to offset, you know, doctor spouse that's making $750,000 per year.
Great, thanks.
Yeah, I think continue on with the plan, and then if someone has more questions about real estate professional, we can connect offline.
Sure. Third bucket. All right. This is a very frustrating bucket. It's not going to make a lot of sense to you, and you know, it just is what it is. But this third bucket of income is called portfolio income. Okay. And it can be hard to distinguish portfolio income from passive income. Portfolio income also often tends to be passively earned, with one exception. It's where interest, dividends, and capital gains, not from real estate, go. So if you're a hard money lender, even though your investment might be secured by real estate, your activity is not investing in real estate. Your activity is lending to real estate people. All right. So if you're a hard money lender, private lender, the interest from that belongs in portfolio income bucket, as does dividends that you may receive, or capital gains not from real estate. If you're getting capital gains from selling a rental property, those capital gains actually belong in the passive income bucket. But portfolio is non-rental real estate related interest, dividends, and capital gains. What's frustrating about this bucket is passive losses may not offset portfolio income. Portfolio income kind of gives you the worst of both worlds. If you have a loss from portfolio income, it can only offset future portfolio income. If you have a gain, it can't offset passive losses. It's just subject to ordinary tax rates. If I need to explain all that again, I'm happy to. But again, the long and short of portfolio income is it's, you know, just interest, dividends, and capital gains that are not related to rental real estate or the sale thereof. They're just in that bucket, and they're aggressively taxed, just like active income may be. But what's important to take from this is, don't think, even though portfolio income may be passively earned, don't think portfolio income offsets passive losses. That's just one very strong distinction here. Are we all good on the three buckets of income? Okay. Let me
I'm
move
sorry,
on to the
maybe
list here.
quick question.
Yeah,
Yeah, so, but the capital gains has two different designations, right? Long-term and short-term. So
correct.
that's taxed at different
That is
levels,
taxed
right?
at different rates. That is
Right,
correct.
okay.
And dividends also have a distinction as well. There are non-qualified dividends and there's qualified dividends. Again, I could get into the difference between that. It's not going to be very material to you guys outside of one fact. Qualified dividends are also taxed like long-term capital gains, whereas non-qualified aren't.
Hey, Nate, how long can you carry forward losses?
Passive losses?
Yeah, passive loss.
Indefinitely.
Okay.
Until some politician comes in and wants to get rid of them. But as of right now, under the way the current laws are written, it's an indefinite carry forward. They don't run out.
Okay.
So going to our list here, depreciation on syndications, including cost segregation and bonus depreciation. So syndications, oftentimes when I see syndications, the way that they are put together, you tend to be passive, all right? You're not active in management. You're not really part of it. You're just you're money guy, right? Kind of comes back to that example with the real estate brokerage, you're money guy. You're not really involved in management. You're not involved in the active daily pursuit of the activity. You're just money guy. You put your money in, you expect some sort of a return. So working within the original framework that I laid out in the first 15 minutes of the call, if you have a syndication in rental real estate or rentals thereof, any losses from that, you're going to be subject to those passive loss rules that I laid out. You're going to be carrying forward those passive losses basically into perpetuity until you dispose of that investment or you have passive income or capital gains from rental real estate to realize against those syndication losses. We brought up the real estate professional designation. There are some rules related to that make losses from syndications difficult to qualify for the real estate professional designation that I spoke of. Again, I could get into that. It could take the length of the call, but for purposes of right now, just assume even if you qualify as a real estate professional, passive losses from syndications don't fall into that bucket where you're allowed an unlimited amount of deductibility. There is a special rule baked into that basically says you still need to materially participate within the rental real estate activity for those losses to qualify for the real estate professional designation. Again, I could get into that more and more. My advice would be if you want to learn more about how syndications work, if you are a real estate professional and that's all you do full-time or your spouses, consult your accountant outside of the call because that requires very careful in-depth planning. But for purposes of this call, if you get into a syndication, the basic understanding is if you generate some really big passive losses from that, those are going to carry forward against future passive income. Jim laid out cost segs. I'm not going to spend a lot of time on cost segregation and the mechanics of it. Just understand what a cost segregation is. It's this nifty trick where an owner of rental real estate can go hire a structural engineer to come in and do a detailed appraisal or an analysis of the building. And it usually results in you getting to write off anywhere between 20 to 35% of the building's cost in the first year. I'm not going to get into the guts of it. Just understand it's a strategy and it's there. So if you engage in a syndication where they're offering to do a cost segregation to drum up a bunch of passive loss, how could that benefit you? Well, let me start with a situation where it doesn't benefit you. Again, if all you have is active income and you don't have passive income, it's not really going to benefit you in the short term. You're just going to be creating this massive passive loss from this activity that can carry forward into future years. And again, there's two situations that allow you to use that passive loss. Number one, you have to have passive income from other sources. So, if you're a successful rental real estate landlord, let's say you have, a ton of units and every year you're generating a passive income of $100,000 or $200,000. And you're thinking, you know what? I really don't want to add more units. I don't want to add more high maintenance type rentals. My property manager sucks. I don't want to give him any more responsibility than what he already has. I'd rather just find an investment that doesn't require near as much of my time, but maybe it makes sense from a tax standpoint. This would be a perfect opportunity to invest in a syndication that does a cost segregation. You might get 20% of, you might get 5, 6, 10% of a syndication where, your share of the loss might be $100,000 in the first year. And does that mean that you lost $100,000 on your investment? No, but for tax reasons, you get to write that off in the first year. And the mere investment in that passive syndication that generates that loss could shelter one entire year of rental real estate income just by making that investment. So that's a good strategy. That makes sense to me. But if you're going to be engaging in these aggressive syndications, you just got to make sure you can make the passive losses work for you. The other situation where getting to use those losses from a syndication would be just disposing of the asset. I hope that's not a strategy. You don't want to be disposing of an investment in a syndication where after all these years, you have a net loss. Awesome tax strategy. Terrible financial decision. So again, just make sure your financial strategies are aligned with your tax strategies. They don't always work together. And anybody that's worked with me will know I make that a very, very strong point when I offer tax planning sessions. I'm not going to be the accountant that just blindly gives you awesome tax advice that doesn't run parallel to good investing advice. I can tell you to buy a car every single year and it'll do a fantastic job of sheltering your income. But what are you actually doing to your long-term wealth? You're devastating it. So again, you need to make sure whatever tax advice you're given makes sense from a strong financial standpoint as well. So again, just be aware of that as well when you're investing in syndications. Make sure you're not doing it for the tax motives. You're doing it for good, strong financial outlook motives. And if they have great tax motives that go with them, awesome. But understand what the tail is and what the dog is. The dog is the financial motive, and are you investing in a good syndication? What's the tail? Well, the tail is the tax benefits that come with it. Don't ever let the tail wag the dog. Just keep that in mind when you're working with syndications.
Sorry
yeah.
to interrupt. Would you mind maybe running through like a quick example? Like I'm thinking, I just invested in a syndication, put $75,000 into it. They're doing a cost segregation this year, and the syndicator said he's going to be able to get me 80 to 90% passive loss or deduction this year
On your
that
investment, 80 to
75,000.
90% of your investment?
Of the 75,000, he said
Yeah.
80 to 90% of that I'll be able to write off year one because of the cost seg.
Sure.
So I've got some rental real estate, but the loss isn't going to be that big. So you're saying it's held in perpetuity for future use for future years. So say he sells in 5 years, and then I'm getting let's just say like 100,000 or something back at that time. At that point, whatever's left of that passive loss, I can still count against that
Yes.
capital gain at that point.
Yes.
Okay.
Now understand something with cost segregations. What's the deduction from cost segregation? What is that deduction? Depreciation expense, right? That's all it is.
Right.
It's this massive, super awesome depreciation expense.
Right.
If the investor sells the underlying rental real estate in the final year, you're also going to have something called depreciation recapture.
Right.
So in that final year, hopefully you have this big capital gain, but you're probably also going to have depreciation recapture because they took a hell of a lot of depreciation expense in the first year.
Right.
And if anybody, speak up now if anybody doesn't understand what I just said about depreciation recapture.
Can you go over that a little bit? I mean, it's not a one-for-one thing, right? My understanding is that the recapture is maybe taxed at a different rate than if you would have not done the depreciation. And then, and if, let's use Mark's example, let's say that you have maybe a $70,000 depreciation loss in year one, and then he sells it in year 5. Is it apples to apples? Or are you going to have a $70,000 recapture hit, or does it change a little bit? It's a little confusing to me.
Well, in the case of passive losses, where the passive loss carries over into the same year that the recapture is hit, it will be an apple to apple sort of thing. But with tax planning, if you get to realize the depreciation expense in a year where it's actually utilized, When I do tax planning for folks, here's a good example. They may be in a year where they're in the highest bracket. They're in the 35% bracket or 37% bracket, and they're looking for deductions. And I might tell them, hey, go buy a truck where you get to write off $25,000 in the first year. And that $25,000 will all be realized in a year where you're in a 37% bracket. So the tax savings at 37% times, 25,000, which, is going to come out to, like $8 or $9 grand or something. But they may turn around and then sell that truck in a couple of years in a year where they're in a 15% bracket. Maybe money's down, they want to just liquidate some assets. And it doesn't need to be a truck. It can be a rental property as well. But the depreciation recapture comes back to you, at ordinary tax rates. So you might be able to recapture it in a year where you might be in a lower ordinary bracket, like a 15% bracket, and you can pay back that deduction in a year where the payback rate is, again, a lot less than the year where you got the deduction. So yeah, it's absolutely possible to manipulate those rules, Jim. But in Mark's example, where he got a lot of cost seg deduction in the first year, yeah, he might get some of it, against his passive income that might otherwise get taxed at a higher rate than the year he finally sells. But in his example, most of that cost seg depreciation would probably be realized in the same year he's having to recapture a lot of that, the year that the underlying promoter sold the property.
But so let's say he sells the property for $100 grand, and whatever the depreciation, he recaptures it, but he takes that full $100 grand and does another deal and has, another big cost seg, then that just balances out, right? I mean, they cancel each other. And so the strategy then is continue to buy a new asset when you sell an asset, so you get the new depreciation. It kind of, one of the guys calls it the golden hamster wheel. So you keep your depreciation going, right? Is that a strategy?
I also call it a lazy 1031 exchange, because with a 1031, you are actually exchanging the asset. You're not touching the money. The whole goal of it is, I don't want to pay tax on this capital gain in the year of sell. So by escrowing the money with a title agency and doing a 1031 exchange and not touching it, I don't have to pay tax on the capital gains. A lazy 1031 exchange is where you don't do any of that. You just sell the property, have a capital gain, and then turn around and then buy another property, do a cost seg, and the cost segregation generates enough depreciation or shelters the capital gain that you ended up having to realize because you didn't do a 1031. But it has the same result. You're sheltering a lot of that capital gain with the new cost segregation.
And Nate, as long as you're doing that in the same tax year, there is no time limit with that, just so that it's happening.
Yeah, you're not bound by that 45-day,
exactly.
You're not bound by any of that anymore. It's all happening in the same year. Now, if you stagger years, that's not good. That won't work. It has to occur in the same year, as you mentioned, Chad.
Okay. And you could take that 100 grand and invest in 4 different 25 grand a piece or whatever. It really doesn't matter.
Yeah, it doesn't matter.
As long as they're getting cost segregated, you get the depreciation. It all happens in the tax year.
Correct.
You can keep rolling that forward.
Correct.
And Nate, can you have purchased them prior to a deal selling? So if you invested in 2 deals in Q1 and then you had it.
And I'm sorry to interrupt. We're talking about the lazy 1031.
A lazy, yeah. Yep.
Yeah, it doesn't matter.
Doesn't matter, just calendar year.
With the lazy 1031, discard any of these really stringent, awful rules that require that you can't touch the money, the 45 days, you got to recognize a certain amount of profit. Those don't apply anymore to the lazy 1031. The only thing that really applies is what Chad laid out. You got to make sure that the sale of the properties that are generating the gain happen in the same year that you got the cost seg on the new property.
Got it.
There are other smaller details to that can totally blow that strategy up. I'm just giving you the bare bones. Make sure you check with your accountant, et cetera, et cetera.
Golden hamster just sounds a lot better than lazy 1031. Just saying. But yeah.
Any other questions on that before I bounce to the next topic? So oil and gas. I'm going to talk about oil and gas real quick. So oil and gas are a really nifty little exception to the passive loss rules. Okay. So if you guys invest in an oil and gas role, chances are you're all going to be passive. All right. I don't know about you, but my guess is almost everybody here knows jack shit about drilling for oil or gas. So you're not going to be cranking the wheel or dropping the bucket. I'm kind of illustrating my own ignorance. I have no idea how this works, but nobody's going to be participating in the actual management. So all of us are going to be by default passive, because even if we wanted to manage, nobody would want us near an oil or gas well. So, again, this is probably as passive as it gets with an investment. But there is a part of the tax code. I couldn't tell you if it went back to that 1983 reform or what, but somewhere along the way, some oil entrepreneur was able to pay a lobbyist to put in this one particular exception to these passive loss rules. And what this exception says is, if you invest in oil and gas well, and you can get the promoter to label you as what's called a general partner. Okay. Most syndications, you're labeled as a limited partner. Again, I'm not going to get into that. It just means that you're not allowed to participate in management. You're passive. You don't really have any liability, et cetera, et cetera. But if you can get the oil and gas promoter to make an election so that you are a general partner, okay, what that means is you are no longer subject to the passive loss rules, even if you are not participating in management, even if you have no idea what you're doing when it comes to operating the oil and gas well. You don't need to participate in management. You just simply need to own the investment, and you're going to need the promoter to label you as a general partner. If those two things happen, you are actually able to fully deduct your losses from an oil and gas well in the first year of investment. So again, it's just this nifty little rule. Does anybody see any sort of issue with what I just said? And I'm not asking if you don't understand it. This is an actual leading question. I'm asking if anybody can see a chink in that armor, a potential problem.
Are you on the hook then? I mean,
what's that?
So as being a general partner, don't you now have a bunch of liability that you wouldn't have had?
Bingo. Absolutely, that's the issue. You know, my response to that's going to be?
No.
Check with your attorney. I'm not an attorney. I would love to be an attorney. I think it's fun to pretend to be one every now and then. And see how long I can take in conversation giving legal advice until I tell you at the very end, oh yeah, by the way, I'm not an attorney. None of this is legal advice. Check with your attorney. So again, there could be an issue there. Check with your attorney. I don't know. I mean, he may need to read the operating agreement. He may need to read the paperwork. He may need to be absolutely certain that you're just a general partner on paper, but at the end of the day, you are protected because of the umbrella insurance. You're protected because somewhere baked into the operating agreement, you're limited by liability because of XYZ or the state you're in, et cetera, et cetera. The possibilities are endless. I just want you aware that from a tax standpoint, it's there, it's available. You can make that election. You can select to be a general partner. And because of that, you will be allowed full deductibility of the losses in year 1, 2, 3, or whatever. And oil and gas wells have their own version of cost segregation. It's called intangible drilling costs, IDCs, intangible drilling costs. And it basically, again, I don't really know the science behind it. Promoters are really good at telling you all about it because they want your money. They're going to tell you all about IDCs and how in the first year they estimate their IDCs are going to be, trying to remember who brought it. I think it was Mark that said that a promoter told him that he was entitled to 80 to 90% of his investment in year 1 as a loss. These oil and gas guys are really good at that. They'll do the same thing. Hey, you give us 100,000, we can get you 80% of IDCs in the first year. You can deduct that in full against your active income as long as we make you a general partner. That is a thing. That's true. 100%. That's a thing. You can do that if you want.
Are those deductions all depreciation? So there's depreciation recapture, or are those losses just deductions that are permanent?
It is not depreciation. It's something called depletion. And depletion is, imagine, probably the best way I can explain this is, imagine that you buy a big pool of oil several hundred feet below the ground, and over time that pool needs to be estimated and it decays in value because you're using it up. That's depletion. You're depleting the oil reserve. That's all it is. IDCs are just depletion being accelerated, a portion of it into year one. I don't know the math behind it. I don't know how they do it. I don't know how long the yardstick is that they dip into the oil reserve. I have no idea. I can just tell you IDCs are a thing, and they're going to have the same conversation with you that Mark's promoter had with him. They'll tell you, you give us this much, we'll get you this much in IDCs in year one. That's oil and gas. It's pretty simple. And again, it's a violation of our passive loss rules that I set up in the first year. So, it's a neat little violation. I will throw a little bit of water on your fire real quick. Again, awesome tax benefit. You can use IDCs, but just make sure from a financial standpoint, it's your best investment alternative. Just keep that in mind as well. Don't let the IDCs dictate your thinking. It's a nice little cherry on top of the ice cream, but you got to make sure your ice cream's good. It's the flavor you want, and it treats you well. So just keep that in mind when you're investing in oil and gas. Any questions on that?
Nate, there's also solar. You can invest in solar companies that install solar things and on top of rooftops, that kind of thing.
Mm-hmm.
And I understand you have the similar types of tax deductions with that too, that you can offset active income. Are you familiar with that?
For alternative energy, yes, there are some deductions there. I'm going to be honest with you. I'm not as sharp on that right now, where I can speak impromptu. If anybody really wanted to look into it deeper, I'm more than happy to look into it, do some research. In my planning sessions, I have suggested solar energy, geothermal energy, whether it be investing in or using it as alternative sources for your own home. And I just seem to be met with so much resistance and people not interested in going green when it comes to their investments. People seem much more interested in, staying black with oil and gas and those sorts of things. If I'm being honest and candid with you, I just have not invested as much research time and educational time into alternative energy because, frankly, my clients just they're never interested in it. It's always a wasted planning suggestion. But, if I had a client, or somebody like yourself that had interest in, wanting to look at those things, sure, I'd look into it for them. I'm sure they're out there.
From what research I've looked into, it's actually a tax credit, not just a deduction on your basis.
So for solar panels or geothermal heating, if you were to invest in those and put those into your own place of business or in your own home, you do receive an unlimited credit of 30% of your investment. Is that investing in solar energy companies? No. But if you invest in those alternative sources of income for your own investments or home, yeah, you absolutely receive a 30% credit of the improvements that you put into it.
All right, thank you.
Next on the list are conservation easements. Has anybody heard anything negative about conservation easements?
You get audited every time, is what I've heard. Every time you invest, you get an audit.
Has anybody heard of something called the IRS's Dirty Dozen? Okay, go ahead after this call, and you're even welcome to do it on this call if you want. Google IRS Dirty Dozen, and you'll see right away. Basically what it is these are the things that piss the IRS off the most, and conservation easements fall into this category. I'm going to be honest, I hate conservation easements, not because I'm afraid of an audit, but there is so much ambiguity to these things. Let me explain a conservation easement. So you can go out, you can buy natural land that's protected, that it's a wildlife refuge. You can buy it as a private citizen. And if you agree or you work with the local government not to improve it, you just hold it the way it is. Or you can even, build your own house on it, and the rest of the land you agree not to improve. You may be able to receive a charitable contribution. You might be able to receive a deduction equal to the lost opportunity of not developing that land, if that makes sense. So a conservation easement, you're basically partnering with the government or a local government agency to not improve land for the benefit of nature, for the benefit of conserving land, et cetera, or whatever interest that the government has, and whatever, again, lost opportunity that you incur because you agree not to develop that, you can get a charitable deduction for. That sounds really awesome. You can just get a deduction for doing nothing, really. This also happens to be why the IRS loves auditing this. Is it's so subjective. It's just out there, and promoters love pushing conservation easements, because it just gives them a lot of wiggle room to just come up with their deduction. I don't know if anybody invested in the PPP loans or heard of that, but my impression when I heard of the PPP loans coming out this summer, I'm looking at how, a lot of cases it was kind of subjective who qualified. And there's just a lot of ambiguity, and there was a really awesome benefit. Anytime in taxes or government programs, if you combine a really, really, it sounds too good to be true type benefit with a very loosey-goosey subjective list of rules that let you qualify for the benefit, those two things, when you combine them together, make a really great suit called fraud. And there's a lot of opportunity for fraud in conservation easements, and for that reason, it makes that list. So if you're the type of person that doesn't mind audits, you don't mind the IRS going through your things, you have nothing to hide. Yeah, invest in conservation easements. But understand something, and this is one of the scariest things about working with promoters or accountants. If you invest in something and the IRS disagrees with you and disagrees strongly to the point where they're going to make you pay back all that tax savings and the penalty and the interest, and you go to them and say, what was the promoter? I mean, the promoter guaranteed this. He said it was great. Or you go to the IRS and say, hey, my tax planner, he told me to invest in this. He said it was foolproof. He even put it in writing. He signed this document. And you even show that to the IRS, or you show the promotion to the IRS, they're going to look at you and say, choose your advisor wisely. I'm sorry, we can't help you. In other words, you get held accountable for anything going wrong. And these promoters, you can go sue them if you want, but again, now you're having to play catch up. You're having to, I call it chasing points. You're behind in a football game or a sporting event, and you're having to come from behind. That's coming from behind. You don't want to ever be in that situation where now you're having to hire attorneys. Now you're having to throw more, bad, good money after bad. Again, I'm being kind of doomsday about this, but I just want you to understand conservation easements can be a money pit. And you're right, Jim, they have the highest frequency of audit than any tax position that you can take. And it's for that reason. It's just they're abused so often by promoters, but they are a thing. You can get a deduction for not doing things that you're otherwise entitled to government protected or historic property. That is definitely a thing. Told you I'd throw water on your fire. Any questions on conservation easements? Okay. I'm going to move on to, let me talk about 1031 exchanges real quick. I can do this one of two ways. I can go through 1031 exchanges, or I can just answer specific questions everybody has about them.
Yeah, I think maybe questions. Does anybody have questions on 1031s? I think probably most of us know roughly how they work, but is there something specific?
If nobody has questions, I'm just going to go through the basic rules.
Yeah, I have a quick question. So can you do a 1031 exchange into a syndication? So let's say I want to sell a couple of rental properties.
So yes, you can. And you'll want to write this down if you're really interested in this. You have to structure it through something called a Delaware statutory trust. And that's just a really fancy name for having your attorney come up with some bullshit type of LLC or trust that just holds your interest in the syndication. So yes.
If I can just jump in here, my tax advisor, when I sold a bunch of multifamilies, said something about a tax tail and a dog, and then just said, look, sometimes you're lucky and you make some money, so just sell it and maybe invest in some syndications and use the cost segregation. He didn't call it a lazy 1031. I like that. But that's what I did. And I think it's a lot easier than trying to figure out a way to finagle a 1031 with a syndicator, because the syndicators don't like it and it causes them problems on both ends. So it's just complicated. And I am really pleased with my cost segregation from the syndications to offset my gains. So that's just my own personal opinion.
Yeah. And it's, whatever you guys decide to do on this, again, I think Jim put it well. Just make sure that there's a lot of careful planning involved, because timing is everything. 1031s, everybody's all about them because, it's just a cool way to keep exchanging and building up wealth without, having to pay tax along the way. I can share with you my experience on my very first real estate deal that I ever did. I made an offer on a 6-unit over in the Fall Creek apartment complex here in Columbus. I think it's close to Worthington type area. I made an offer on a 6-unit there, and the guy that was selling it, he wanted about 100,000 more than what I was willing to pay for it. And I was looking at it, I'm thinking, this could be a good deal, but I've learned that in real estate, you got to be just as good at saying no than what you are yes. So I'm going to pass. Numbers just aren't there. I just, with my first deal, I don't want to speculate, so I'm going to pass. 10 days later, his realtor calls my realtor, and I consider this malpractice in hindsight, not by my realtor, but by his realtor. You know what his realtor told me? His realtor says, hey, my client's actually involved in a 1031 exchange right now, and he's got to make this work. So let's just make this work. I said, well, I really didn't want to make this work, but sure, why not? Let's knock 70,000 off the price and let's see if we can make this work. And the guy actually accepted it. And, the lesson there is this guy forced the deal. Now, I couldn't tell you what he exchanged into. Maybe he got a deal of a lifetime and it worked out really well. But he was so desperate, and his realtor voiced that same desperation for reasons unknown to me. I don't know why a realtor would ever admit to the seller that my client is backed into a corner. He has no choice. He's got to make this work. For whatever reason they did. And I ended up getting a great deal as a result of it. But the lesson with 1031s are, you need to be careful. You don't want to make, you don't want to get into some really bad means to justify the end, is my point. And this guy was just so settled not paying the tax that, he ended up costing himself on his deal with me, to justify some sort of investment on the back end. And again, maybe it was the investment deal of a lifetime. That I'm not certain about. But what I can tell you that I am certain about is he lost 70 grand on the sale. So just think of that when you do your 1031 exchanges. Just if you're going to get into it and you're going to pay the $700 to $800 to the qualified intermediary to hold your money while you're trying to make the deal work, you need to be emotionally mature enough and mentally ready to let the 1031 fail if you're not getting a good deal on the back end. Just think of that. Just be ready for that and accept your lumps. That's probably the best advice I can give you when it comes to 1031s. Don't force them if it doesn't make good sense. Any other questions on 1031 exchanges? Easy enough. Pluses and minuses of IRAs, investments and syndications. Is anybody here familiar with UBIT, unrelated business income tax? Is anybody not? Just give me a good raise hand or unmute yourself and say I'm not. Okay. So UBIT, unrelated business income tax. It's a nasty tax. It totally defeats the purpose of a self-directed IRA. Completely destroys it. Makes it foolish. UBIT basically says that you cannot use your self-directed IRA, or you can, but if you use your self-directed IRA to invest in leveraged real estate or in a partnership that uses leverage for real estate, you are going to owe an excise tax and it usually comes out to somewhere between 25 to 30% on the income that was derived from said leverage. Okay. So let's say my IRA invests in a self-storage unit, or huge, 20 self-storage units that are held in a syndication, and the amount of borrowing or lending that IRA used for those self-storage units was 80%. All right. What the UBIT rules say is my IRA, 80% of all the income that's generated on that K1 is going to be subject to another 25 to 30% tax. Because if you source all that income, it's sourced through an investment that was 80% leverage to generate its profit. Awful, just bad stuff. It's foolish to use your IRA to invest in a syndication, partnership, LLC, whatever that utilizes leverage. And if they utilize pure cash to make the purchase, sure, you avoid UBIT. But if there's any sort of usage of debt, technically you fall under the UBIT rules and you should be paying an excise tax.
Hey, Nate, what would you say? Like, I've talked to syndicators, and I don't do business with these syndicators anymore. But their basic thing is, well, yeah, you might have to pay UBIT, but you're earning a 15% IRR, so it would be better to invest in this because the only money you have is in this self-directed. So it's better to invest in this than to not invest in it.
My response to that would be just go lend the money out at 12 to 13% as a hard money lender, charge a point or two, and you're making the same IRR without incurring UBIT.
Right, and that's the message, I think, for people that have a self-directed IRA is I only invest in lending. I only lend money out of that account because you lose the depreciation, right, Nate? And you also have this UBIT. There's no real reason to do that out of your IRA. You might be better to, ask your accountant, but to cash it out, take the penalty, and then invest rather than continuing it in your IRA.
Maybe. Again, I'm not going to say yes to that because I'm not going to tell anybody to cash out retirement early and subject those penalties. But, again, there's ways to do that. Yes, that could make sense. But the big message I would want anybody here understanding is don't use your IRAs to invest in syndications or any LLC or anything that has leverage. Don't buy a property and take out a non-recourse mortgage on it and be surprised when you're paying a tax on income that you thought was going to be deferred or pushed off until retirement. Don't do that. Now, there's one exception to that. You can use a solo 401k to invest in leverage property and not pay UBIT.
And Nate, right now also too, this year until the end of this calendar year, because of the CARES Act, you can withdraw up to 100,000 without penalty, correct? Of a 401k.
Correct. Or you can withdraw 100,000 and pay it in 3 installments over the next 3 years.
Right.
Pay the tax, that is, or pay it back in 3 years and you don't owe any tax.
Right. Yeah, I'm actually planning on doing that. And it's funny, like my employer, out of like 60 some employees, no one has even asked about it. But and when I did, it's absolutely an opportunity that we can take advantage of. So I would encourage you guys to maybe look into that too, if that's the situation you're in.
Which income bucket would that fall in? Active, passive?
Active.
Active.
I'm trying to think of the logic. The answer is definitely active. Why is it active? I don't know. I mean, it's, it's sourced to wage income that had to be active to defer to begin with. So, but without getting too much into the logic, it is 100% active income.
Yeah, and I guess one of the reasons I'm thinking about it too is because I think because of this cost seg of the syndication I'm investing in, I'll have a decent passive loss, so that won't go against the 401k because that's considered active income.
Correct.
Oh crap. Oh, maybe not.
Yeah. The CARES Act, that is a thing. You do need to make sure that your employer is participating in the CARES Act. I know that you need to call them, and HR needs to have done something in their 401k plan to allow that. But coming back to that UBIT issue, again, you could roll your IRA into a solo 401k and invest in leveraged assets and not incur UBIT. If your next question is, well, why is that? My answer would be, I don't know. It's just, that's the rule.
Can you, so if you're investing with a solo 401k, so you're avoiding the UBIT, but you're still not getting the benefit of like the depreciation or the cost segregation, correct? So is it, if you had 100 grand in a solo 401k and 100 grand in cash, non-qualified money, I mean, you'd always do the non-qualified first, correct?
Correct. Yeah. I mean, doing a cost segregation inside of a tax deferred vehicle doesn't make any sense. It doesn't do anything for you.
Right. Okay.
The pluses of doing an IRA or doing a syndication in IRA, I mean, you've already mentioned it. It's just whatever your IRR is. I mean, just make a good financial decision, and you know, if you can make a better internal rate of return in a syndication or a market that you're comfortable in, and you have good and better information in than the normal S&P or whatever is going to make that 6 to 7%. Congratulations, you've made more than twice your IRR. But again, that comes down to your own personal information and, you know, your scrutiny and, you know, judgment in making your own investment. I've gone through the list on my end. I know we're just over an hour. I'm happy to spare a couple more minutes if anybody has any questions about any of this, or, you know.
Yeah, but before we do questions, there was one more, the conversion to, if you have a self-directed IRA converting to a Roth, is there,
Yeah.
Can you talk about that? And then just real quick, and then if anyone has questions after that, maybe if you have time, that'd be great.
So converting to a Roth, whatever the value is of the IRA as of the date of conversion is just taxable income. So, you know, just understand if you have an IRA that's worth $100,000 and it's all pre-tax and you want to make it a Roth IRA, you're going to have $100,000 of income hit your return without you having any of that cash to show for it. So you got to be ready to pony up the tax on that with money that is external or outside of the IRA. You know, that's the basic mechanics of a Roth. Is it beneficial to have a Roth IRA? Yeah, it can be. The factors that you should consider whether you should convert or not. One, it's a combination of factors, but one, are you in a year where you have below average taxable income? Is that a good year to convert? Yeah, it is, because you're letting that income hit in a year where your rate is down and the tax that you pay on that conversion is low. And and this walks into point number two, if your retirement is going to come back to you in a year where your tax bracket is likely to be higher than your bracket is in the year conversion, this makes a lot of sense. Now you're playing bracket arbitrage, paying tax on the conversion at a rate that's lower than what the pre-tax money would otherwise come back to you and get taxed at later on down the road. So again, bracket arbitrage, convert in a year where your rate is lower, much lower than what the rate would otherwise be when all that pre-tax money that hadn't been converted comes back to you and you pay tax on. You know, those are the first couple variables. The next variable would be after the date that you convert, is your investment going to make a very high IRR? The higher the rate of return, the more sense this makes. So again, if you convert in a year where you're going to pay a 30% rate, and the rate that you would otherwise pay on the money coming back to you later on in retirement is also 30, if those things aren't a factor, then just look at what your investment is, what the IRR is. If it's a high rate of return, it might make sense to convert. Get that investment making that really high rate of return in a period where you'll never pay tax on that money, and that only occurs within a Roth IRA. So again, convert your assets before investing in an asset that's supposed to kill it or do really well. All that doing really well is eternally tax-free if it occurs after you convert it to a Roth IRA. It's another point to consider. The final point to consider would probably be how long do you have for that money just to sit in there and eternally continue to grow tax-free? If you have a long period of time, great. That makes more sense the longer you have for that money to compound and compound eternally tax-free. Does it make sense to convert to a Roth and then hold the money into your IRA for a couple of years? Probably not, because you're not really getting the benefit of that investment. And the investment is the tax that you're having to pay at the time of conversion. So again, like any investment, if you pay it and it has some time to grow and keep compounding, that investment becomes much more valuable. So again, that's probably the other point to keep in mind of the decision whether to or not convert. Again, it's a big mix of factors. There's a lot of variables, a lot of things that could go wrong, a lot of things that could go right. It's just important to have a good tax planner that can just kind of lay it out for you and help you make that decision.
Perfect. Any questions for Nate? I see Chad and Paul each have questions. So why don't we start with Chad?
Yeah, so Nate, first off, thanks so much for joining us tonight. This is great stuff.
You're welcome.
We started as a group back in February, March or something like that. We probably should have had you be our first guest speaker because this stuff is solid. That is fantastic. So I appreciate it. We talked a lot about cost segregation, depreciation.
Yeah.
Bonus depreciation was mentioned too. I don't know that we covered it, and I'm not super familiar with bonus depreciation. Is there a 2-second thing you could cover on it, whether it's worthwhile to discuss for us?
So cost segregation is getting to realize a whole heck of a lot of bonus depreciation, right?
Okay.
Bonus depreciation is you writing off what I call fixtures within a property, not structural stuff, but fixtures. The Internal Revenue Code calls it personal property, right? I would imagine this, and I use this analogy with all of my clients. When I'm sitting in my office in New Albany, I say, hey, look around my office real quick. If I left my door unlocked in the middle of the night and some thief walked in and he took things out of the office, anything that he would take that wouldn't damage the underlying structure of the property, that is personal property. And it is extremely likely it's going to qualify for bonus depreciation if you're putting such improvements into your own rental property. Some good examples: appliances, carpet, LVL or laminate type flooring, things that can be easily replaced without damaging the subfloor. Cheap kitchen cabinetry, ceiling fans, any equipment, any furniture, any decor, anything like that. Landscaping also qualifies. Anything outside that the good Lord didn't put himself, that qualifies as land improvements. So if you go out to a nursery, plant a tree, land improvement, shrubs, land improvement, pavement, land improvement, fencing, all of these things qualify for bonus depreciation. And what is bonus depreciation? It's you getting to write those improvements off that are increasing the value of the property as if they're repairs. Just write it all off in the first year. It's really cool, making improvements to your rental property, and you're getting to just totally deduct those improved costs that are raising the value in the first year that you make those costs. And the logic behind cost segregation is you hire an engineer to go through and he runs a fine-tooth comb through your property, and he aggressively points out all these fixtures in a detailed manner, and he's upping the percentage of your purchase price in terms of fixtures and not structure, and it allows you to write off all that uppage in the first year. That's the theory behind that.
Just a
Perfect,
follow-up
thank you.
question. Sorry, follow-up question to that, Nate. So if there's a different president come January 20th next year, and the tax law changes on bonus depreciation, how soon could that take effect? And the second question is, should we start investing more syndication so we can take advantage of that to collect our bonus depreciation tickets for the future?
Great question. So the tax reform that exists right now, at least from my perspective, is great from an entrepreneurial standpoint. You get all these deductions, you have the bonus depreciation, you have all these things that compensate the entrepreneurial for the risk that they take. So this is a very favorable tax plan that exists right now for entrepreneurs. It's favorable as it's ever been in the history of taxation, ever, 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 ever. And for that reason, if we pull the slot machine on November 7th and we get blue, blue, blue all come up, in other words, House, Senate, presidency all turn up blue on that slot machine in November, here's what's going to happen. Usually tax reform doesn't happen until about 6 to 7 months after, maybe a little earlier, after, all three turn blue. And sometimes it happens in a presidential election year, sometimes it happens in a midterm year. It just so happens when President Trump was elected, everything turned up red, red, red. And they put tax reform in effect, I think that summer. Here's the thing about tax reform. If it results in lowering taxes, they make it retroactive. So that presidential tax reform that happened in 2018, that actually happened after the midterms. I'm trying to think of my dates here. Oh, they didn't get around to tax reform well until later in the year. It was too late for it to be retroactive. So they made it proactive to 2018. But a lot of times when they put in a tax plan that is good and it lowers taxes, a lot of times they'll make it retroactive to the beginning of the year. Oftentimes in political history, when they put in a tax plan that raises taxes, they make it proactive. It's bad politically to put in a plan, even if it sides with your party lines. It's bad politically to rewrite the rules to raise people's taxes retroactively. It's bad whether you're a Democrat or a Republican. So anytime they put in a plan that is proactive or bad and raises taxes from that standpoint, it's always proactive. So in other words, if summer of 2021, after we get blue, 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 they rewrite a plan that gets rid of all these entrepreneurial things, in my opinion, it's a 95% likelihood that all of those bad things, in terms of wiping out the bonus depreciation, getting rid of the 20% deduction for entrepreneurs, all that stuff, those things wouldn't take effect until 2022. So you would still have a full year after this one to still take advantage of all those things. 2022 would be the year that they all get unfurled. So yeah, in terms of investing in syndications and squeezing those things in, so you can take advantage of them. I think you're going to know first week in November what your time clock is to fit those things in. But it's not like you'll have a month and a half to do it. Any advice I give to people, of course, there's that 5%. I'm going to say, hey, who knows? Maybe they'll get it done in January and it'll be early enough that they'll make it retroactive to the first of the year. But I would feel very comfortable based off of everything that I've seen as long as I've been an accountant. Politically, it's just suicide for them to retroactively raise taxes, giving the average person no ability to plan whatsoever. You still, as a politician, you still got to give people an opportunity to plan for it. You can't do it retroactively unless you're lowering taxes, people like that.
Thanks for that answer.
Any other questions?
I've got one, Nate. You laid out an example in the beginning of the call of a doctor that makes $750,000 and a spouse that manages a 100-unit rental portfolio. They're classified as a real estate professional, so they can write off of their passive losses as active income against the spouse's income. Is that correct so far?
Correct so far.
So it's also my understanding that manager of the portfolio would not have any Schedule C income, and to have a solo 401k, you need a Schedule C box to be filled in with some income. Is that correct?
Schedule C, or you need that active. Self-employed income. Yes, not rental or passive, but it has to be active. So yeah, you would need property management income that is being forced onto a Schedule C. Sure, that's one way to do it. Yes.
Okay, so if that professional was classified as a property manager, then yes, they would qualify for a solo 401k. But if they were not a property manager and they were just managing the portfolio, let's say with hiring a property manager, but they were more asset manager, would that qualify?
they would have to pay themselves as an asset manager. In other words, their rental activity would have to 1099 and pay themselves an asset management fee of some sort that would be reported on Schedule C.
I see. Thank you.
Yep.
All right, any other questions? Okay. I think we'll close here. And Nate, I cannot thank you enough. This was fantastic. If anyone wants to talk to Nate and offline, just send me a note and I will share his contact information. I appreciate him coming on. He does a great job. And if you're looking for a new tax guy, you might as well at least interview him because he does a super job. With that, we'll close here. And for those, I'll send out an email to figure out our next meeting. I have a couple ideas, and I'm sure some others do. So if you have ideas for meetings, let me know. Otherwise, I'll send out a note, and we'll figure out when that next one is. But thank you all very much, and especially Nate. Thanks for your time. This was fantastic.
Yeah, Nate, thank you.
Appreciate it.
Appreciate it.
Thanks, Nate.
Thanks,
All
Nate.
right.
Thanks,
Bye,
Jim, for
guys.
coordinating.
Yep.
Bye,
Have a
guys.
good week. We'll see you.